The Iraqi Dinar today latest news. The alternative currency sphere, a community deeply invested in the subtle shifts of global monetary policy, was jolted by one of the most remarkable technical incidents witnessed in recent memory. Precisely at the stroke of midnight Eastern Standard Time, a silent but powerful digital tremor moved through the internal infrastructures of several prominent banking institutions across the United States. This was not the kind of routine market day, a fluctuation that analysts track daily. Rather, it was a sudden and synchronous event that instantly drew the attention of specialized system monitors. For those watching the global financial heartbeat, this occurrence transcended the typical noise of the foreign exchange market, suggesting something of far greater significance was unfolding behind the scenes. This phenomenon was reported almost simultaneously across multiple large-scale banking operations, including names familiar in the world of American finance, such as Wells Fargo, Bank of America, and Fifth Third Bank. Within their respective proprietary foreign currency modules, the screens and consoles accessible only to authorized staff, unusual data began to surface. The common thread across these disparate institutions was the momentary appearance of significantly revised exchange rates for two specific, non-major currencies, the Iraqi Dinar IQD and the Vietnamese Dong VND. These reported values were not minor fractional adjustments. They were substantial shifts that pointed toward a fundamental change in valuation, however fleeting their presence proved to be on the internal platforms. Reports detailing the rapid vanishing act of these newly displayed numbers quickly emerged. Within seconds or minutes, depending on the specific institution and system, the anomalous rates either disappeared completely, reverted to their previous levels, or transformed into cryptic statuses such as pending, restricted, or out of service. The brevity of the display, however, did not prevent quick thinking bank personnel from allegedly capturing screenshots of the transient figures. These digital images, however unverified, immediately became the focus of intense discussion and speculation within online communities dedicated to tracking these specific currency movements and the possibility of a global monetary revaluation. The immediate aftermath saw an explosion of activity across various online financial platforms. Telegram groups focused on currency speculation experienced a massive spike in membership and commentary, turning into digital cauldrons of excitement, caution, and debate. Similarly, message boards and subreddits associated with global economic reform were flooded with thousands of new posts, comments, and fragmented analyses, all attempting to decode the meaning of the synchronized flashes. A clear division quickly formed between those who hailed the event as definitive proof of impending changes and others who insisted on exercising extreme caution, highlighting the lack of official confirmation from global financial bodies. The silence from the official entities responsible for these currencies only amplified the speculation. Neither the Central Bank of Iraq (CBI), the State Bank of Vietnam, nor major international organizations like the International Monetary Fund, IMF, issued any immediate statement to acknowledge, explain, or deny the synchronized rate flashes across the U.S. banking sector. The coincidence of the rates appearing across multiple institutions at the exact same moment, seemingly coordinating a digital event on an international scale, was deemed too significant to be a random technical failure. This synchronized occurrence instantly became the central point of a shared question resonating across thousands of observers. Was this the beginning of a long, anticipated monetary adjustment, or simply an authorized system stress test gone slightly visible? Those with a deep understanding of the global foreign exchange infrastructure recognized the distinct signature of the event. They posited that such synchronous anomalies often occur when interbank and sovereign-level financial systems are undergoing rigorous, behind-the-scenes preparation for major policy transitions or new rate structures. This process typically involves multiple rounds of internal back-end testing, where temporary data injections, system-wide refresh operations, or network-level simulations are performed to ensure data integrity and correct propagation across various institutions. These tests are meticulously designed to remain entirely invisible to the public and consumer-facing systems, taking place deep within protected banking consoles and institutional firewalls. However, in rare instances, especially during large-scale upgrades or major systemic changes, minor visibility leaks can occur. A back-end developer might initiate a data propagation cycle that accidentally bleeds a placeholder or test value through to the front-end user interface. A teller's foreign exchange screen might flicker with incorrect data, or a rate database might fail to suppress a line of code intended for internal verification only. Today's synchronized digital flashes bore all the hallmarks of this precise technical pattern. An unintended visibility leak during a highly structured, multi-institution testing phase, a moment where the curtain of global finance lifted just enough for a brief glimpse of the internal preparations. Crucially, analysts noted that these anomalous rates were strictly confined to internal banking systems. Major, public-facing financial data platforms such as Bloomberg, Reuters, and all publicly accessible Forex trading portals showed no indication of any new or adjusted values for either the IQD or the VND. This detail was highly significant, as it strongly suggested the activity was not a real-time market event, but rather one confined to the interbank or sovereign-level networks, the highly restricted areas where only institutional actors, central banks, and treasury systems operate. The containment of the data leak underscored its nature as an internal readiness procedure, rather than a premature public announcement of a currency shift. The Iraqi Dinar, in particular, has long been the subject of extensive international conversation regarding a potential revaluation. Its inclusion in this synchronized event was the primary catalyst for the day's fervent excitement. Iraq's substantial oil reserves, coupled with a deliberate movement toward greater political and economic stability in the post-conflict era, have long been cited as fundamental factors supporting a stronger currency in the future. The country's gradual adoption of modernized financial governance, moving away from past instability, positions it as a potential candidate for a significant economic recalibration, aligning its currency value more closely with its massive resource wealth and improving national output. Under the recent administration, led by Prime Minister Mohammed Shia al-Sudani, Iraq has actively pursued and implemented aggressive financial reforms aimed at modernizing its entire monetary structure. These reforms include strengthening anti-corruption measures, enhancing the digital payment infrastructure, reducing the economy's reliance on US dollar transactions, and actively working to clamp down on currency smuggling operations that have historically distorted the dinar's true market flow. These initiatives represent tangible steps toward meeting the benchmarks required for deeper integration into the global economic system, giving weight to the notion that the country is strategically preparing for a significant financial update. Adding further context to today's anomalies, the Central Bank of Iraq made a notable announcement earlier in May, indicating that preparatory work for establishing a unified market reflective exchange rate was nearing completion. This statement had already resonated strongly within the international finance community, viewed by many experts as one of the clearest signals yet that Iraq was actively setting the stage for a future strengthening of its currency. The timing of the digital flashes across multiple major U.S. banking systems now seem to align with the strategic implications of that earlier announcement, reinforcing the idea of an organized multi-phase back-office event that is now entering its final, high-level testing stages. Meanwhile, the appearance of the Vietnamese Dong on the synchronized screens was considered equally remarkable and noteworthy by financial analysts. Unlike Iraq, Vietnam has experienced rapid and sustained economic growth over the last 2 decades, becoming an impressive manufacturing hub with a consistently expanding middle class and strong international trade ties across the globe. Despite these robust economic fundamentals, the dong has consistently been viewed as an undervalued currency, deliberately maintained at a conservative level by the State Bank of Vietnam to support the country's export competitiveness on the global stage. The country's economic strength has frequently led to commentary from institutions like the IMF, which have hinted that the dong's current valuation is artificially low and may be ready for an adjustment that better reflects the nation's true purchasing power and economic stability. In recent times, Vietnam has also taken proactive steps to align its monetary operations with global banking standards, implementing new cross-border payment systems, enhancing capital flow monitoring, and adopting enhanced regulatory frameworks to increase financial transparency. These reforms suggest that the nation is also participating in the broader global effort to update and align sovereign currency valuations. Therefore, the synchronization of the Vietnamese Dong alongside the Iraqi Dinar in today's rate flashes was a significant point of interest. It hinted at the possibility that Vietnam, perhaps through system testing participation, may be involved in a larger, interconnected alignment of emerging market currencies being prepared for updated global valuations. The simultaneous nature of the event across multiple Western banking nodes strongly suggested that these were not merely isolated national actions, but potentially part of a far larger, coordinated shift in the treatment of specific sovereign currencies within the Western banking lattice, signaling a high degree of international cooperation. Though the Zimbabwean dollar ZWL was not part of the rate flashes detected in the U.S. banking systems today, it remains an important currency in the overall global revaluation discussions. Zimbabwe has a complex history of currency instability, including episodes of hyperinflation, but has recently embarked on ambitious steps toward monetary rehabilitation. Early in the year, the country introduced a gold-backed currency model as a central element of its economic stabilization program, a move that attracted significant international attention, especially after the African Development Bank noted improvements in its gold and foreign asset reserves. Some analysts interpret the ZWL absence from today's U.S. flashes as an indication that its integration may be scheduled for a later, multi-phase rollout, following in the wake of early mover currencies like the IQD and VND. This multi-phase approach is characteristic of the methodical, deliberate processes employed by global financial institutions, such as the IMF, World Bank, and the U.S. Treasury, when orchestrating major, large-scale rate adjustments. These institutions are known to operate through slow, process-driven channels to ensure global stability, meaning that a staged rollout is a likely scenario for major sovereign currency changes. Recent country assessments by these influential global bodies have consistently placed both Iraq and Vietnam in a favorable light, specifically noting substantial improvements in their governance, monetary frameworks, and digital infrastructure readiness. For example, IMF assessments have recently praised both nations for their aggressive modernization efforts, suggesting that the necessary foundational groundwork for a major currency shift has been successfully laid. Furthermore, the U.S. Treasury's latest semi-annual report on currency manipulation notably did not list either Iraq or Vietnam as currency manipulators, a powerful indication of increased trust and cooperation in international financial relations. This background of positive global regulatory assessment aligns with the common knowledge that sovereign and level currency adjustments typically undergo extensive, private back-end testing before any change is made publicly visible. The Bank for International Settlements (BIS), a key organization for global central bank cooperation, has long confirmed that these simulations are standard protocol. Therefore, the simultaneous appearance of these specific, adjusted rates across multiple Tier 1 banking systems is not seen as a random event by seasoned analysts, but as a textbook sign of an internal readiness simulation, a structured, carefully timed procedure involving the active participation of numerous financial institutions. Following the initial, brief flash event, reports surfaced that several of the affected banks had implemented or temporarily suspended foreign currency services, citing system updates or unexpected maintenance outages. While such messages are a routine part of banking operations, the timing, perfectly coinciding with the high-profile digital flashes, provided additional compelling evidence for the theory that these institutions were actively transitioning to new system configurations or performing deep-level, high-impact maintenance operations in preparation for a major event. This confluence of technical anomalies and immediate operational restrictions only served to fuel the widespread speculation among the global community. The effect on online activity was immediate and measurable. Day-to-tracking services showed a massive surge in traffic, with sites dedicated to the Iraqi Dinar and Vietnamese Dong experiencing spikes of over 300%. Screenshots, however unverified and of dubious quality, continued to circulate across financial forums, accompanied by a mix of excited affirmations and cautionary pleas. Yet, beneath the clamor of social media, more compelling, off-record information emerged from trusted sources within the financial ecosystem. Two separate insiders, one reportedly a former IMF advisor and another linked to U.S. Treasury systems analysis, allegedly confirmed that synchronized digital flashes of this nature are a characteristic signature of a coordinated liquidity environment test. These highly classified tests are an integral part of the structured pre-activation procedures used to ensure full institutional readiness before new, finalized exchange rates are formally rolled out. One of the sources reportedly commented that when internal test rates are accidentally exposed to the external view, even for a brief moment, it often signifies that the entire internal process is rapidly entering its final stages, pending only the final political approvals, comprehensive compliance verification, and the final settlement preparation protocols. This technical insider perspective offers a rational, process-driven explanation for what, to the public eye, might otherwise seem like a chaotic and inexplicable digital glitch. Further heightening the sense of impending movement, rumors persisted that select high-net worth clients began receiving highly subtle, coded messages from their private wealth managers. These messages reportedly advised clients to ensure they remained locally available and maintained open lines of communication for a specific period, often cited as the next 3 to 4 days. Historically, this pattern of communication has been known to precede major institutional announcements or significant shifts in global asset structures, serving as an unofficial signal to elite clients that critical transition points in the financial world are drawing near. For those holding the IQD VND and potentially the ZWL, today's events served as a stark and powerful reminder of the importance of disciplined readiness, moving beyond purely emotional decisions. Analysts reiterated the critical importance of gathering and securing all original documentation related to currency purchases, monitoring only official sources for confirmation, and proactively identifying banking institutions with dedicated foreign currency desks to understand their specific procedures for foreign exchange transactions. The need for clear, documented records of all interactions and transactions was emphasized as paramount, prioritizing practical strategies over speculative excitement. While various speculative models from financial consultancies continue to circulate with hypothetical value projections for these currencies, it must be understood that these figures are strictly projections. entirely dependent on underlying economic fundamentals and the continuation of global regulatory cooperation. The core, undeniable fact remains: the coordinated digital flashes observed today bore a strong resemblance to the technical patterns seen before previous major institutional shifts in the global financial system. Regardless of whether this was a final pre-implementation test, a system-wide simulation, or an unexpected glimpse behind the secretive curtain of global finance, the activity unmistakably signals meaningful and structured movement beneath the surface. The hours that followed the synchronized digital flashes brought a tangible rise in global financial tension. Contained within the secure corridors of major banks and distant financial headquarters. Although the event itself was described by some as lasting mere seconds, the aftershocks continued to reverberate in private conference rooms, across encrypted terminals, and in hushed, late-night calls among the small number of high-level personnel whose careers are fundamentally intertwined with the complex mechanisms of sovereign finance. From an analytical perspective, this moment confirmed that the world behind the polished, public-facing exterior of retail banks, the world of shadow, tier networks, and cross-border settlement engines, was indeed stirring with activity. The atmosphere was not one of chaos, but rather the unmistakable rhythm of highly sophisticated systems being rigorously tested, adjusted, synchronized, and aligned in a manner only a handful of technical insiders truly understood. Among the first to register the magnitude of the anomaly were specialized analysts stationed in a critical international facility that monitors the heartbeat of high-level currency transmissions, a global interbank messaging coordination hub. In this ultra-secure environment, supervisory teams detected highly unusual propagation signals clustered across multiple US-based financial nodes, all routed through channels typically reserved for high-sensitivity trials. To these specialized analysts, the data signatures were subtle but distinct and undeniable. The system had initiated a multi-institution propagation check, a rare and highly classified procedure designed to test whether sovereign rate adjustments could be successfully transmitted through domestic and international networks without suffering data loss or distortion. Such procedures are only authorized when the highest-ranking monetary authorities are approaching a critical decision point. The inclusion of the Iraqi Dinar and the Vietnamese Dong in such a high-level test was striking. But even more so was the fact that the test data had become externally visible, fulfilling the worst-case scenario of visibility leakage for the system's architects. Deep within the Central Bank of Iraq's Secure Strategy Wing, senior officials convened, their attention fixed on projected readouts detailing real-time data threads from international partners. The CBI, committed to modernization, had long been working toward an eventual integration into a reformed global monetary framework. Officials studied the flash reports, noting the wide geographic spread of the anomaly across at least 8 major U.S. banking systems. Though some were startled, others appeared unsurprised, having likely anticipated that the complexities of the transition phase would eventually lead to some kind of external visibility, even if against internal wishes, potentially risking the upsetting of delicate political and economic balance points. Meanwhile, in Southeast Asia, the State Bank of Vietnam's Central Monetary Operations Chamber experienced equal intensity. The Vietnamese currency's valuation had been the subject of long-running economic debate, with the nation's consistent growth and expanding trade surpluses seemingly at odds with its conservatively pegged exchange rate. When the SBV team received reports that the VND had appeared in U.S. banking systems at adjusted values, disbelief momentarily swept the room. The data was swiftly parsed against internal timelines to determine if the high-level testing phase had inadvertently begun ahead of schedule, prompting immediate encrypted communications with international consortia overseeing transition protocols. Inside both headquarters, analysts meticulously scrutinized every piece of data. They noted that the adjusted values had not only flashed in U.S. systems, but that internal nodes in other countries were also registering synchronized rate injections, strongly suggesting the event was part of a larger cross-regional banking test. The continued absence of Zimbabwean data from this specific U.S. test also provided an intriguing clue, suggesting that the ZWL integration may indeed be scheduled for a subsequent phase in the multi-stage rollout, a phased approach that is highly consistent with structured global financial transitions. As the news of the digital flashes inevitably exploded across social media, certain established analysts who had long predicted such a technical event suddenly became highly visible. They authored lengthy posts explaining that major currencies cannot undergo a public revaluation without first successfully completing synchronized testing across the world's Tier 1 banking systems. Their theories resonated with many who viewed the brief digital flashes as validation of long-held expectations within the integrity divisions of the global treasury system. These analysts understood that a visibility leak of this magnitude would place immense pressure on institutions to respond, pressure they were likely not yet prepared to confront publicly. Division directors within the affected institutions promptly issued internal directives to senior staff. No public statements were to be made until a complete review of the propagation logs was finished. They needed time to definitively identify what mechanism triggered the visibility leak, and to determine whether the system was transitioning into the stabilization and verification window, an internal period in which cross-border settlement engines test their final connection to sovereign nodes before any official rate announcement is permitted to surface publicly. This measured, non-reactive response underscored the gravity and complexity of the internal event. The wealth management sector, particularly firms catering to exclusive elite clients, continued to send out their cryptic, coded notices. These messages, devoid of explicit terms like revaluation, subtly advised clients to remain highly accessible, avoid non-essential long-distance travel, and keep all communications open for the specified window, often cited as the next 72 hours. Historically, this highly specific pattern of communication has only been activated when major asset structures or financial access mechanisms are confirmed to be approaching critical and imminent transition points, serving as a powerful, non-public indicator of movement. The Theoretical Sovereign Rate Reconciliation Board, a body often imagined to exist solely for ensuring stability during currency transitions, would, in this narrative, be meeting in secure facilities, with representatives from various countries participating. Their presumed task would be to review the U.S. flash incident with surgical precision, determining that while the propagation sequence had advanced earlier than expected, the underlying technical functionality was positive. The unexpected variable was solely the visibility glitch, likely triggered by a non-critical diagnostic override that briefly allowed internal data to surface. And so, as the hours continued to tick toward potential transition windows, individuals around the world who had followed these currencies prepared themselves not out of panic, but out of measured and deliberate readiness. They spent the time gathering and securing all pertinent documentation, meticulously reviewing their accounts, contacting their trusted advisors for logistical counsel, and quietly formalizing practical plans. They understood that the forthcoming period, whether it resulted in a confirmed revaluation, a complex system, wide stress test, or some other unexpected development, would ultimately require the utmost clarity, patience, and financial discipline to navigate successfully. The digital flashes were not the conclusion of the long-running narrative. They were the stark, technical commencement of a much larger, highly complex sequence of global events.